Hey guys, what's up? It's Gleggio. Today I want to talk about the housing affordability crisis. This is a huge issue, both economically and politically. It's taken center stage in the New York City mayoral race. Generation Z voters are making it their single biggest issue because they believe that they're unable to afford housing in ways that previous generations have. It's also a big difference between how the right and the left is talking about this and how they're ascribing blame to the root cause of this problem. On the left, people are talking about greedy landlords and monopoly pricing that's, artificially driving up prices. And on the right, you have people talking about the government strangling development and keeping the housing supply from going up, which would lower prices. Reality is complex. And the root cause is actually something different than these two things. It has to do with a quirk, a once in a lifetime, or maybe once in a 1,000-year financial markets quirk that I'm going to get into, and I'm going to give an ultra-realist take of the housing affordability crisis, what's really causing it, and some potential ways that policymakers could move forward. But first, I want to give a little bit of background because there is a little bit of data here that we should get into. Right now, in 2025, the average price of an existing home sale is about $410,000. Now, for some reference, that's about $100,000 more than it was 10 years ago in 2015. And if you go back to the market bottom in 2009, 2010, it's almost twice what housing prices were. But the housing market is tricky because people aren't going out and buying, they're not spending cash on houses. It also depends on the financial markets and basically, can they get a mortgage for a home? And then second, what is the price of the debt that they're taking on in order to buy this home? Basically, what is the mortgage interest rate? And the second thing that's happening right now is that mortgage interest rates have spiked. Right now, the average mortgage interest rate for if you were to buy like a $400,000 house is almost 7% in the United States. Now, this is crazy because if you go back just 4 years to the end of 2021, mortgage rates were down below 3%. And this is having a huge impact on housing affordability. Okay, so for one example, suppose you went and purchased a house for, I'm going to keep the numbers simple. So suppose you bought a $500,000 house in 2021. If you had a 3% loan on that house, all right, versus today, you had a 6.5% loan on the exact same $500,000 house. I'm assuming no down payment, just to keep the numbers simple. Today, your mortgage payment would be about $3,200 per month, whereas in 2021, your mortgage payment would be about $2,100 per month. So literally $1,100 difference, more than a 50% increase in the home, not in the home price between 2025 and 2021. It's actually been about the same because there was a huge spike during the COVID years. But the home price in terms of a monthly payment is almost 50% more than it was just 4 years ago. So there's really is a big deal. And the only time that has ever been more expensive was in the early 1980s, not when housing prices were high, but when mortgage interest was crazy high and getting a 30-year loan would cost something like 17, 18, 19% interest. And that drove average home payments to about $2,600 a month adjusted for inflation. Right now, for all homes right now, it's about $2,200 bucks. All right. But here's the thing about housing that's really crazy, is that not only is there this market for the brick and the mortar, for the sticks that you're actually buying and the dirt that you're buying, then there's also this market for debt, which is what allows most people to buy homes. Virtually no one pays cash for a home. You'd have to be extremely wealthy, or maybe you're selling your house, you have a lot of equity in it, and you downsize and you pay cash with your sale proceeds to buy a house. But most houses are bought with debt, right? The third aspect of this is the market, not for the mortgages, but for secondary mortgage debt, all right? So you go to the bank, you get a loan, you sign a contract that's based on a piece of property that you're going to pay off this property over 30 years, and you're going to pay $300,000 of interest over the course of 30 years or something like that, right? That contract can then be bought and sold by investors and by banks, okay? And there's a huge market for that secondary debt, all right? But here's where it gets crazy, all right? I'm going to give another example, and I'm going to make the math as simple as I can just to show how wild the market is today. Okay, so if you bought $1 million house, say not a $1 million house, but if you took $1 million mortgage in the end of 2021, when mortgage rates completely bottomed out, you could get a mortgage on a $1 million home for about 2.5%. The jumbo rates were actually lower than the regular FHA loan rates. For whatever reason, it was a quirk in the market. Okay, so $1 million at 2.5% would yield $25,000 of interest income to whoever owns that debt. Okay, so you're paying as a customer, you're paying $25,000 of interest, and then the bank or the investor is receiving $25,000 in interest income. Okay. Fast forward 5 years, today, same jumbo loan is about 7.5% for $1 million. Okay, so that $1 million loan on the exact same house, instead of yielding $25,000 of interest to the investor, is going to yield $75,000 to the investor. And what does that mean for the loan that was issued in 2021? Well, it's interesting because the face value of that contract says that it will be paid off $1 million over 30 years, right? With a certain amount of interest. But if they go and sell that contract to another investor, no investor is going to pay $1 million for that contract because they can lend out $1 million at 7.5% today. So how much is that $1 million contract worth today? It's worth about $350,000. Okay. So the loan, the contract from the 2021 loan is worth $650,000 less than a new loan issued today. Okay. So what does that mean practically? It means that if you are someone who owns that loan, who doesn't own the loan, but who owes on that loan, if you're to pay it off at the face value, at the $1 million, you would actually be bailing the bank out of a $650,000 loss that they would have if they took that contract and sold it to another investor. You'd be bailing out the bank, all right? So everyone today who has a 2.5% loan who sells their house and is forced to pay off their loan in order to buy another house is literally writing a huge check to JP Morgan or Bank of America or Wells Fargo or some sovereign wealth fund that owns a bunch of mortgage-backed securities. You're basically doing them the biggest favor in the world of basically paying them off for this huge loss that they have not realized, all right? They would realize the loss if they sold it to another investor, but you've come in and saved the day and paid them off by giving them $650,000 that does not exist in the market. Okay, so what's happening in the marketplace today? Well, I did a little bit of research, and it turns out that 25% of all outstanding mortgage debt in the United States is priced at under 3% interest. Another 27% is priced at under 4% interest. This means that 54% of all of the mortgage debt that's outstanding is priced at 2.5 percentage points less than the market rate for debt today. Which means that of the 54% of houses that have that debt, if they were ever to be sold, it would be at the expense of the homeowner to the relief of the bank. Now, what I realized a few years ago, because I was looking at the financial markets of 2021, and everything was expensive. Stocks were expensive. You might remember there's this huge run in the stock market. So stocks were crazy expensive. Debt was crazy expensive because the mortgage bonds were priced very, very high because the interest rates were low. Even gold and precious metals had gone on a big run leading up to COVID. There was very, very little in the financial markets that was cheap except debt. So people went out and they refinanced everything. I actually went on a hunt for rental properties because I wanted to take out as much debt as I could because I believed that 2.5% mortgage rates or 3% mortgage rates on an investment property was something that was never going to happen in my lifetime again. If you think about it, a 3% interest rate, inflation now is over 3%. So if you own a $1 million mortgage note that's paying, where you have to pay 3% per year, also you don't pay taxes on the interest that you pay up to the banks on those because the government subsidizes it, you're actually getting paid to hold that note. The debt instrument is no longer a liability for you. It's actually an asset, okay? And it's flipped the whole entire financial markets on its head. Because what it means is that anyone who gets out of a 3% or 4% or lower mortgage note is actually selling an asset. They're not selling a liability. And this has flipped the whole entire market on its head. King Solomon once said very wisely that there's nothing new under the sun. I think that this might be the first time in human history that this has happened because the whole market for 30-year mortgage debt has not existed throughout human history. In fact, it doesn't even exist in most countries. It's almost sort of unique to the United States and Britain where you can actually get a 30-year loan on a house. All right. So there is something very unique and weird going on here. And with 54% of people with these 4% or lower loans, everyone is locked into crazy amounts of equity in their homes, and they're unwilling to sell because selling is no longer selling a liability. It's actually selling one of their assets. All right. This is a crazy flip that's never happened before. When I came to this realization, I realized I'm actually probably never going to sell my primary home, at least not until the loan is almost paid off. I might move to another house, but I'm not selling this house. I'll probably turn it into a rental and then save up for another property. But it doesn't make any sense to sell this house as long as it has that 2.5% mortgage note, which I was able to lock in 2021. So how do policymakers fix this? Because there is a lot of sclerosis going on in the housing market. No one wants to sell their houses because they don't want to get out of these crazy low interest rate loans that they have, which are not liabilities. They're actually assets. What can policymakers do? Well, the easiest thing to do, the most simple thing to do, I don't know if it's the easiest thing, would be for the Federal Reserve to go in and just like artificially start buying up mortgage-backed securities, and that would drive the price down for mortgages. All right, that creates all kinds of crazy market distortions, and I don't think that they want to do that because all of a sudden you'd have a giant bonanza for housing again. It would probably drive up housing even more because we haven't done anything to the housing supply. All right, what else could you do? Well, one thing that you could do is the financial markets create a market for homeowners to purchase back their mortgage notes, not at the face value of the loan, but at the market rate of the loan, right? So if you have $1 million of mortgage debt that you owe the bank $1 million on, could instead you buy that note back from the bank or whatever investor, Bank of America, JP Morgan Chase, the Saudi or Norwegian sovereign wealth funds that own the mortgage-backed securities, could you go back and buy that mortgage note back for $350,000 if you owned $1 million on it? Or if you had a $500,000 house, could you buy the note back for $150,000? I think if you were able to do that, people would think about it at least, right? I mean, will you pull $150,000 out of your 401k to pay off your house and not have a mortgage payment? I think a lot of people would do that. So I think that there's some creative ways that policymakers could look at this problem. No one's really talking about that yet. I'm not sure the banks would like it too much, although they're already buying and selling loans on their, in the secondary markets, but only in and among banks, not to the consumers that are paying off those notes. But that would be one way that policymakers could loosen up the housing market by letting folks buy back their debt at market rates, not at the face value. But who am I? Why would they consider doing such a thing? It makes too much sense, right? Let me know what you think. Drop a comment and let me know. Thanks.